Hello, everyone. I'm going to wait another minute or so, see if anyone else walks in. I know people are trying to make their way around. Thank you all for coming, too. We really appreciate you being here.
We appreciate you.
Oh, good. Good. Who's having fun so far? Good. We're going to have some fun talking about cash flows today. Actually, I can say that it's an honor to be here to introduce actually my best friend, Kurt Button. He is a lot of fun, even though he's in accounting. You'd be surprised. They do tend to have a lot of fun. So hopefully this presentation you can learn a lot from him. So I guess we'll get going then. So I know Kurt Button. I've known him for years. He's actually been our accountant for Rocket Ring since we opened. I met Kurt when he was at RIT studying as accounting, and ultimately he went to MNB in 2010 after being an intern there for a number of years after graduating from RIT with his MBA. And he has recently been promoted to a principal at MNB in the assurance department. Kurt focuses his time on serving closely held businesses and non-for-profit organizations, including several breweries. Kurt strives to develop relationships with his clients that allow him to support their unique needs and support their continued success. So I'm going to turn over the mic to my friend Kurt and learn about some cash flows.
Thanks, Chris. Can everybody hear me? As Chris said, I am a fun person. Unfortunately, cash flows is not the most fun of presentations. So if you start nodding off, I will not be insulted. Hopefully everybody's got a beer in them. Try and engage, ask questions. I am going to talk about accounting, so I'll try and explain any accounting terms that I use. I know that those accounting terms are probably not on everybody's radar, so if you have any questions, you need further explanations, please raise your hand, stop me at any time. So we're going to talk about cash flows and profit and how they kind of interlink and how they are used to assess your business. So each of these are extremely important metrics to measure your company's performance. When you're looking through these, you need to understand both of them to kind of see where your company, where the brewery is aligning with your goals for the brewery, where your strategies are going, any of those objectives. So by understanding both of these, you can kind of see where your company is going and make those necessary changes as you watch your production and everything go through. So one thing here is, as you look through these strategies and you look at your income statement, so when I say income statement, I'm going to be say P&L. That's just looking at your revenues and your expenses there. And then we have what's called a balance sheet. This is where if you have inventory, so your grains, your hops, your yeast, all that stuff that you've purchased that's going to become your beers before they're sold, that's considered inventory. We have accounts receivable. That's when you make a sale but you haven't collected the money on that yet. So that's your accounts receivable. Your accounts payable, we're talking about any of those invoices, so you made a purchase of that inventory, but you haven't paid for that. So that's an accounts payable. So kind of understanding those words, that's going to lead into later when we talk about some of our profit stuff. So profit, we have really kind of three categories of profit. So at the base level, our profit is simply defined as the amount of money that remains after all your expenses have been accounted for. So that's the goal. We have to include things like taxes, interest on your debt, and non-cash expenses like depreciation. So depreciation, to keep it simple, is when you buy a piece of equipment, you buy a fermenter, you say that piece of equipment's got a 5-year life. Well, what you can do is you take that expense and you break it down and spread it over those 5 years. So your cash is going out the door immediately, but on your income statement, that expense is going to be straight lined, or it's going to be spread throughout the life of that asset. So next we're going to look here at these three different categories that I mentioned. So we have gross profit, operating profit, and net profit. Net profit, most easily known as your net income. That's all the expenses reduced from your profits. Your gross profit, this is going to be very important for you to understand as you are brewing your beers. This is all those costs to create that beer, to produce it, the labor that's used, the inventory that's used. So you take the revenues that you bring in, all your sales of beer, and you reduce it by those exact costs, and it gets you to your gross profit. That's going to be a very key metric in understanding how to price your product and things like that. Next is your operating profit. So that you're going to take that gross profit, and you're going to reduce it by all those other expenses that are required to continue the business. So you're looking at your rent expense, supplies, repairs and maintenance, things like that, just to keep the day-to-day brewing activities going that don't necessarily go into creating your beer. So actually, one question for everybody. Does anybody have an idea of how much you spend on your marketing in a period of time, say a month? So that's one of those things where this is where you want to be looking at your profit and you want to understand, where's my expenses going? If your marketing expense is pretty low, then maybe you want to think about, hey, my sales could be higher if I spend a little bit more on that marketing. So by looking at that profit and loss statement, looking at all those expenses, you can kind of identify where you are taking in the most expenses, where you could cut down on some, where you could build some up to hopefully generate more revenue. One other note here is you could be looking at having a net loss during the year. So with all those expenses, you're showing negative. But sometimes that depreciation expense will inflate your loss, and you might actually be sitting at a profit when you back out that depreciation expense. Remember, that is a non-cash transaction, so it's not really focused in the P&L in a manner that is always one for one. So some people kind of miss that thought that when they add the depreciation in, it can turn you from having a profit to having a net loss. Cash flows, so this is simply put the cash coming in, the cash going out of the business. So this is really important for you to understand how much liquid cash you have on hand. So this is what cash you have readily available in your bank account, if you have an investment account, things like that. So it's very important. As Sam was talking in the thing, he called his wife and asked, how much money do we have in the bank? Does anybody know how much money they have in the bank at all times, today? I bet you Chris does. Right? That's excellent. You really should know that. That's going to help you make decisions going forward. Hey, can I afford to make this purchase? Do I need to wait a week? Do I need to wait a month? Should we take out debt? Things like that. So knowing how much liquid cash you have on hand is extremely important. So in our cash flows, we break that down into 3 types of activities: operating, investing, and financing. So that operating activities, those are going to be all your sales of the beer, all of the stuff, the day-to-day things to keep the brewery running. So that's really looking at almost taking your profit and loss, that net income number, plugging it into there, and then adding in any of your inventory purchases, because that is actually cash that's going to be used for operating. So you have to remember to pick those things up. Any of those sales that you've made that you haven't collected the money from, that's going to be an operating activity. Investing activities, this is really looking to invest into your company, how you're going to stay in the long run. So that's really focused on the equipment purchases, by building, things like that. Those are the things that are going to last you for more than a year, whereas the operating activity is kind of more of their short-term, what's happening right now. And we have financing activities. These are, if you take out money from a bank, that debt that comes onto your books when you get that cash, that would be considered a financing activity. You guys go out and look for investors. That money that you bring in from the investors is a financing activity. Kind of confusing that it's not an investing activity, since that's what you think. It's actually financing, because it's financing the business going forward. So it's essential to really understand your use of those cash flows, and you can use that profit and loss and this cash flow to really understand how your expenses on a day-to-day basis are being used. We have positive cash flows, we have negative cash flows. The goal is always to have those positive cash flows. So looking at the 2 of them, the profit and loss schedule is, the profit is your goal of the company as well. It's an indication of your financial health. So you're going to look at your profit, you're going to look at that on a larger period of time. You kind of want to keep that to a month, a quarter, a year. Looking at it too narrow of a time frame, you might get lost in the details and you're not seeing the bigger picture. Your profit is going to indicate how long you're going to be able to sustain. If you're able to show profit over year, you probably have that staying power. You're going to be able to continue the brewery. You have to keep pushing through it. Your cash flows is the lifeblood of the company. So, as Sam was saying, the beer is the lifeblood of your company. Well, so is the cash, because the cash pays for the beer, and then the beer brings in more cash. So having that understanding and focusing on knowing where your cash is going, how you're spending it, that's really key here. So a lot of times when we're brewing, we're not thinking about that cash until it's too late. So you need to be making that a priority and basing your decisions on this. Both of these are important for measuring breweries' success and for forecasting. So you can take historical data, so you can look at your past year's cash flows, your past month's cash flows. You can kind of use that to figure out, well, what's next month going to look like? What's next year going to look like? How do I increase the revenues for next year? How do I reduce those expenses next year? Did something happen last year that was a one-time thing? The roof got a hole in it. Some of those expenses are not always going to be there year over year or month over month. So you kind of need to know where that is going on a day-to-day and a week-to-week basis. One thing here also to know, you could be having a net income, positive net income, but you might have negative cash flows. And where that comes into play is if you have bank debt. When you pay your bank debt off, that doesn't affect your P&L. Only the interest is going to affect your income and losses. So you still have to be able to cover your bank debt when you're making all your payments. So you want to make sure that that net income amount is, you're generating enough revenues to cover any of those required payments. So we're going to talk about a couple of efficiency ratios here. The first one's liquidity. So this is going to get really into accounting, so I apologize for this. Show of hands, does anybody maintain their books on an accrual standpoint where you have a balance sheet with accounts payable and accounts receivable? Okay, good. So these ratios here are going to be driven by having that accrual style of accounting using your QuickBooks, Peachtree, whatever. So we have first the current ratio. This is looking at your current assets. Those are defined as your cash on hand, any investments you have, your inventory, and your accounts receivable. Those are things that can hopefully quickly translate into sales, cash, some means like that. And then you have your current liabilities. Those are mainly anything that's due within the next year. So your accounts payable, what you owe to your vendors, accrued expenses if you've got service done but nobody's given you an invoice yet, but you know you have to pay something, you need to keep track of that. What the current ratio is going to really tell you is, are my assets greater than those liabilities? How quickly am I able, and how able am I to pay off my debt as of right now? So it's very important to think about this, and you want to have that current assets number higher than that liability. So the ideal goal is to have a 3-to-1 ratio. 1-to-1 ratio is okay, but you don't want that to be less than 1-to-1. If you do have that, that could be a sign that you are going to have upcoming financial issues from a cash standpoint. The next one is the quick ratio. So the quick ratio, very similar to that current ratio. We're actually now just looking at only stuff that's very liquid, so that means it can translate into cash very fast. So we're just looking at your cash, your marketable securities, which you could sell right now on the market, and then those accounts receivable where you could call your customer and say, hey, I need that cash right now. So that one, your ideal goal is to have it at least above 1. Again, the whole purpose here is we want to be able to cover what we owe. We don't want to have to be calling our vendors and saying, hey, I can't get you your money right now. Can you give me another 30 days? That starts to look bad. It can hurt business relationships. It can tear them apart. So just maintaining that ratio is very important here. Next, we have an efficiency ratios. So these efficiency ratios really look at how the company is able to turn what you have, your beers, your inventory, and to generate that income from there. So it's pretty small, so I apologize here. We have the inventory turnover ratio. This is really looking at your inventory and your cost of goods sold, the amount of expenses that you incur when you're selling. So this inventory turnover ratio is really going to show you how fast do you move through your inventory. If you're moving through that inventory really fast, then maybe you need to be looking at how often am I purchasing my inventory. Maybe I need more. If your inventory is really high and you're not selling as much, maybe you need to be lowering how much you buy each time. So that's kind of an indication of, hey, I need to take a look at how my sales are going, how often I'm buying things. Is what I have on hand, is that translating into cash? Next we have our accounts receivable. So here we're looking again at how quickly are you collecting your money versus how much in sales are you doing. You don't want to have a ton of open receivables because that means you're not bringing in your cash. Yeah, your sales may be high, but if you're not collecting on that, that's going to really hinder your ability to make those purchases that you need. Then we have accounts payable turnover. This is really looking at how quickly you are paying your bills. So the quicker, the better, but you also have to look at that and maintain, hey, is it smart to pay this bill right now, or should I wait till that next influx of cash comes? You don't want to put yourself in a poor cash position. And we have days sales and inventory. This is just looking at how much breer you can make, how fast is that inventory going to go through. It's very similar to that very first ratio here. Does anyone have any questions on this before I go forward?
How do you kind of quantify inventory in more of a service or consulting?
I would assume probably if you're in the service, your inventory, you're probably not going to really have inventory. When you're in a service, you're kind of really selling yourself and your services, which is just more your time. So for you, that ratio wouldn't work. So it's really just going to be looking at how many hours in the day can I give my time to people. Anybody else? Okay. So drivers of the cash flows. So here we're looking, you can see your revenue growth. So that's the goal of every brewery, to see those revenues grow, to be able to take that next step, get into another market. As your revenue grows, obviously your cash flows are going to start to grow as well. Next, you have your cost of goods sold. That's the inventory you're using. So you can see inventory as well. So those two go hand in hand. So as you're making those sales, how much are you incurring to make those sales? Then we have our SG&A, selling, general, and administrative expenses. Those again were those operating costs, just things to run the business that don't directly always impact your ability to sell a beer. And then your capital expenditures, that's the purchases of your equipment, bright tanks, fermenters, new brew houses, things like that. And we have the accounts receivable and the accounts payable. Again, the driver there is how fast am I collecting my receivables, how quick or how slow am I paying those payables. So we're going to go through some cash management tips. So these are not all the tips, but these I feel are very important for you as a business to really focus on and make sure that you are trying to at least incorporate some of these tips into how you run your business. So we're going to start with knowing your profit margins. To do that, you need to really understand how much cost does it take to make one batch of my beer. If I have a lager, I need to know how much grains, how much hops, everything that I'm using to make that lager, what is that total cost? What is my production? How much did I produce? And by understanding that, you can start to understand, okay, is that beer costing too much to make? Is there a more efficient way to do that? And then on the flip side, we have our pricing. So if you know your cost to make that beverage, you can figure out, what do I want my margin to be? Do I want to sell it at a 35% margin, making 35% over what it costed me to make this beer? If you don't know that cost, your price setting is going to be immediately flawed. You need to know that. It's an extreme importance. And because you are going to be selling through different channels, you got to price beer at different prices. So if you're selling to a distributor, they tend to take a lower price from you, so you're not going to get as much of a margin. So you still want to make sure that you're covering those margins. If you don't, that is a surefire way to end up running the company down and not being able to sustain and be there after a year. So when you're making those informed decisions, you really want to gauge what is that margin, and then put that price and see how it's selling at those prices. Your margin may be too high. We have a great community here, so you can call on other breweries and ask, hey, what are your margins? What do you typically try to hit for this? By having that knowledge, you don't want to price yourself out of the market by pricing it too high, and you don't want to price too low and undercut yourself. So having that information, the more information you have is better. So as you do this, there's also, you have to remember, what channels are you selling the beer through? Is my beer a stout, an imperial stout that I know I'm going to sell very well, but I don't have a lot of it? Maybe it's best to keep it at the brewery if you have a tap house, if you have a tap room in the brewery, because you can make the most margins typically if you're selling it in-house. If you're selling it to a distributor, you're probably not going to get that same margin, and that's just reducing the amount that you have available, and you can drive foot traffic in by bringing it back home, or selectively putting it out to different bars, things like that. Track your inventory use. So when you're using that inventory, does everybody have a method of tracking their inventory, or do you just kind of put it on a shelf there? So show of hands, who tracks their inventory on a weekly basis? So I'm sure you guys have spreadsheets, you know the cost of all that inventory. So by watching how quickly you're using that inventory is going to help you decide, when should I be making my next purchase? There's oftentimes people will buy inventory to get a discount on it and buy it in bulk, and it's going to sit on your shelves for 2 months. And in that 2 months, you could have some of that inventory go bad, and then you're just wasting money because that inventory is not becoming cash in the end, to becoming beer. So make sure that you're not over purchasing. When you over purchase, you're spending more money and you're not seeing the benefits of the cash coming in from that. So again, back to the point of, this is a huge community. If you see a great deal, great discount on inventory, maybe call up another brewery in the same town or the next town and say, hey, I can get this discount if I hit this measurement. Do you need any of this inventory? Go in on a purchase order together. There's different strategies that you can take to really reduce your costs and take advantage of those kind of discounts. And then tracking your labor costs. So this one's really big here. Knowing how much you're paying your brewers, making sure that you have the right people and those brewers are producing quality beers and they're being paid enough so that they're not going to try and leave to go elsewhere when you have that right person. So if you know your labor costs, this is going to also help you decide where my beer is going. Is my labor cost enough? Do I not have enough brewers to make enough beer to produce, to send out? Maybe having one more brewer, if you can afford it, will translate you from being able to do 2 batches a week to 3, something like that, which will then generate more cash. Also, if you have a tap room, looking at your bartender salaries, is that too high? Is that too low? Do you have 3 bartenders every day of the week, but on a Tuesday, you're getting 20 people in the door? You don't need 3 bartenders working that day. So really knowing the levels of your sales, you're going to be able to translate that and look at your labor and try and shift that around so that way it works for you, and that way you're not overpaying and you're not just spending money where you don't need to be. All right. Next is monitoring those SG&A, I'm sorry.
I was just wondering, with the margins, I feel like we don't have a published industry standard on what you should be getting on a margin for a 4-pack you sell in the tap room, or a draft beer in the tap room. If we look at that, but we're like, compared to everybody else, I don't really know.
Right. Yeah, and that is one of those things where there's not as much detail unless you're looking at, your Bud Lights and things like that. You can possibly see that because that stuff's published. I really think that because of this community, if you guys start talking, sharing some of that data, yeah, it's sensitive data, but it will help you figure out where the market's at, and you want to make sure that you're not exceeding the market too much and driving yourself out of business. So I highly encourage talk to other people. I know Chris, he monitors his margins daily. So, yes, sir.
When you're establishing your margins, what costs are you factoring into it? Because some of them can be fluctuating, right?
Yep.
Like, are you factoring labor costs as well, but to what extent? Or are you just trying to say that your 50% margin, say, is supposed to cover those ebbs and flows that
Right.
are a little less tangible?
Yep, so very good question. So those kind of expenses, again, all the labor, so you're really gonna be looking at the brewers. So a thing that you could do is implement maybe a timesheet. How much is my brewer spending making that batch? And you know how much you pay your brewers, so you can kind of calculate, okay, typical batch takes, an 8-hour day. I pay them X amount in an 8-hour day, and you can kind of just assign that amount to it. So it's going to kind of be looking and creating spreadsheets, looking at different ways to measure. So I think, Chris, how would you?
Yeah, I mean, that's something we're definitely focused on a lot because it's hard, because even then it's how much you produce in a year, right? Because you have to at some point pick an amount that you think, like Kurt was saying, that you're assigning percentage wise of their salary is to beer production, and then you spread that across the batches is how I do it. It's the easiest way.
Yeah.
But it's hard to sometimes figure out the tangibles of like, well, he's brewing for 8 hours, but like, we're standing here watching water boil for, 2 hours of it, and, where does that factor in? So it's a little.
Sorry, just not to cut you off, but like when you establish the original, like when you're dealing with wholesalers and whatnot, and establish the, like, yes, I have an idea of your operating costs and what that's going to be, but like you just establish higher, so that way you make sure that that nut is covered by the actual. Does that make sense?
Yeah, I mean, you're gonna have to at some point just take a little bit of faith, because you can't spend all day every day tracking your money, because you'll go out of business doing that too. But yeah, so you have to kind of set that. And again, it's good to talk to your other brewers. They're dealing with wholesalers, they're dealing with accounts. They can give you an idea of what people are willing to pay, and if, quite frankly, they're not willing to pay for it, then you might have to look at that product and say, I can't afford to make that anymore.
Got it. Yeah.
So do you include like electricity, propane and that, or is that a different calculation?
So you, again, to what Chris was saying, if you take a look at those expenses, you can allocate a portion of that to there. So if the brew house is running, so many hours a day, okay, so it's 30% of this month's bill. Just throw that there, and how many batches did I make? And you can kind of just spread it out like that. So you don't need to go and track every single dollar. That's definitely important. Use allocations, use judgment here. So definitely strategize. Very good. So we have, you have your fixed costs, and then you have your variable costs. So as Tom just said, so those fixed costs are those ones that you're going to incur every month, and they're not going to change. So the easiest example is your rent expense. You know what your rent is every single month. So and you can plan for that fixed cost. Your variable costs are going to be, your utilities. It's going to be there, but it fluctuates. Those are the ones that are going to be changing, and you kind of have to look and assess a little bit more. And that's where you're going to work on that division, the percentage allocations, things like that. Jeff, did you have a question?
Yeah, I was just going to caveat on the margin question. I can share, we have some national data at M&T that we can share.
Awesome.
That has margins. Granted, we got to look at 19 numbers, but it'll give you just a rough guideline on gross profit margins, what rent expense should be, labor expense. So we have within a 5 to 10% guideline of what you should.
Did everybody hear Jeff?
I can shoot it to you, Kurt, or.
Yeah, that'd be great. Or Chris and I.
Someone, then they can send it out to the group.
That'd be perfect. So Jeff was just saying M&T does have some of that national data for the margins. It's probably 2019, but he's going to share it with us, and we can definitely make sure it goes out to the members. Looking here also at establishing just a consistent cash flow monitoring system. If you're able to track your cash flows, you're going to better know how your business is being run. You're going to better know where you're spending the most of your money. Are you spending it in the right places, things like that. Chris and I, before this presentation, we went through it and he pulled up his spreadsheet of his cash flows. He tracks it on a weekly basis and keeps all the historical every week since, what? 3-4 years. So he can look at that cash flow and he can look and see trends. He can see the data. He can see where he's spending that all. And I'm going to show a cash flow example at the end here, and it's going to be pretty small. Chris's is huge. It's like 60 lines.
Yeah, it's massive.
It's massive, but it can be as large as you want it to be. And it can be, the more information you put in there, the more informed decisions you're going to make because you're understanding that flow of the cash in a better light.
These tools really help you avoid the, oh shit, I have a $20,000 bill, but I only have 25 in the account and I know I got to pay, rent next week or payroll. It's having these tools so that you know what's coming. So it's not just a surprise, a lot of us are very busy and wearing a lot of hats, and you find yourself like, oh wait, I got to pay that bill. Oh, I have to pay sales tax in this quarter, and I didn't remember to set all of it aside. You've got to be prepared. So that's where having these cash flow sheets really help you to know, I have cash on hand, but this cash I can't use because it needs to be set aside because I have this occurring bill that if I don't pay it, I get in trouble, So.
Yep. So then we have monitoring and following up with those open invoices from your customers. So when you're doing wholesale, if you're selling to bars directly and they haven't paid their bill, if they're sitting on your bill for 30 days, 60 days, 90 days, you want to be establishing some sort of method to call the bar up and collect that cash. Because a lot of times we see people just sitting there and going, oh yeah, we'll get it, we'll remember it tomorrow, and that day it just keeps going on. And you could have used that cash for your inventory purchase. You could have used it for your rent expense. You could have used it to cover what you forgot to hold aside for your sales taxes, things like that. Take advantage of terms of payments that are due. So if you ever look at some of your invoices when you buy products, when you buy services, some of them say 2 net 15. That means they're going to give you a 2% discount if you pay your bill within 15 days. 2% doesn't sound like a lot, but if you start and you're able to, if you're taking advantage of that more and more, you're cutting your costs down while still getting the exact same products or whatever. So I say this, don't always just go and try and take that. Again, you need to be looking at what are your cash flow needs in the future so you're not just spending your money before you actually are committed to other things.
Another quick, perfect example too here is saying you're selling wholesale, right? You're bringing in your product, your inventory. You want to set up, if you can, get terms, especially most places will give you 30-day terms. So you have time to make your product, sell your product, but then, especially if you're doing wholesale, maybe try to negotiate with your wholesaler that they pay you in 15 days instead of 30. So then you're closing that gap of, all right, I bought the product, I haven't paid for it, I've made the product, I have now sold the product, but I got my cash in to pay for this product before I have to pay my supplier. So, that's one way that you really get to know your cash flows too, by having some of these spreadsheets of okay, I know it's going to take me 20 days to collect on the sale of this product, and I got 30 days to pay them back. I've now gave myself a 10-day window of positive cash flow.
Okay. The other one here, it seems kind of obvious, but accept various forms of payment. There's a lot of places that still accept cash only. How many people actually have cash in their wallet right now? More than I expected. But it's probably not enough for you to go out and buy a couple rounds of beers or buy food and all that. So by accepting these various forms of payment, you're going to be increasing your customer base. Most people don't want to go, oh, I got to go to an ATM if I'm going to go to this brewery to drink. They want to be able to just pull out their card, tap whatever. Square is a useful one. There's all different types of systems and merchants that will charge, 2% or whatever. Shop around, look at the different percentages, but try your best to be able to accept multiple forms of payment. Yes, sir.
Sorry, when you say that the rate's going to be the trend that's developing where it's going cashless,
Yep. Yeah, so most people don't want to go to an ATM and,
you're still advocating for accepting cash?
yep. You could definitely accept cash, but, definitely have the ability to take other means of
Oh,
payment.
yeah, no, that's actually
Sure.
electronic.
Yep, so,
Cash also.
yeah. Fun story on this. I met Jim Cook 2012 with Chris Finelli, and he said to me, cash is king. So it's really important that you have cash, and that cash can come in multiple ways. So by having those multiple ways to collect that cash in whatever form, that's going to be the huge driver of your company. Another one here, if you have unused space in your brewery, if you have a tap room, things like that, find uses for that space that can also generate other income. Rochester, we have HIT Yoga, or Hike Yoga, I think it's called. And they go around to different places, rent out a little bit of space, they put on a yoga class, and then all the people stay and they have a beer. That's bringing in different revenue for your rental of the space, and it's bringing in new customers and giving your brewery more exposure. Rock Brewing does trivia on Wednesdays, so people come in on Wednesdays for trivia and they're buying beers, they may be buying dinner, things like that. Next, we have looking at how you're making your purchases of equipment. So you want to make sure when you're making a purchase on these sizes, usually that equipment's not cheap. It's going to be pretty heavy to price. You want to make sure that that purchase is going to in some ways bring in more revenue. So, for example, if you're going to buy another bright tank, that's going to increase the amount of beer that you're able to produce and sell at one time. That hopefully should be translating to more revenues. You should also be knowing your sales trends. Am I selling enough as it is? Maybe I need to increase my sales before I think about adding to my production because the sales aren't there yet to meet the new product that you're going to be doing. You don't want to be sitting on your product so long. We also have banking relationships. So M&T Bank is here. They're great to talk to. They can help set you up with a loan. They can set you up with a line of credit, a capital line of credit, things like that. If you cannot make that, if you don't have the cash on hand right now to make those purchases, it sometimes is a very good idea to supplement that with bank debt because you know that you're going to be bringing in more revenue from that purchase. So, and if that revenue is going to cover the debt and make more profit on top of that, then that's a good thing. So talk to the banks, get information. They'll always be happy to talk to you and give you some information there. If you do take that bank debt on, however, remember, again, you need to have enough profit to cover those payments. You're going to be stuck with a monthly payment. And again, if you have a flat rate, that's going to become a fixed cost that does not show up in your profit and loss schedule. The other one here that a lot of people tend to forget is your outstanding checks. If I cut a check and mailed it out to a vendor and they don't cash it right away, it just sits there. Well, that's technically not money in your own bank account anymore. That's somebody else's money. It's just still sitting in your account. So you don't want to write that next check, and that check, those two checks together are more than your balance, and one of those checks bounces. That's never good. So you need to be making sure that you're accounting for all those outstanding checks. And then a general kind of rule of thumb, we like to tell businesses, try and keep at least 3 months worth of cash on hand, if possible. I know that can be hard, especially when you're making purchases and all that. But if you can at least be a little safe from the weather for 3 months. You can, if you get into that hard time, you at least have the cash to keep pushing forward and make it through that tough time. So hopefully you can turn the business around and have cash.
Is that just supposed to cover all operating costs?
Yep. Yeah, so you should be looking at what a normal month's costs are. Definitely make sure you know your fixed cost. Again, with the forecasting, if you have that historical data, you can kind of see what a normal month is going to look like. So try and have at least 3 times that amount. So next we're going to just talk about preparing your cash flows. These are just some general tips if you have the accrual basis of accounting. You can see here what kind of items go into each different type of activity. We're kind of low on time, so we're going to just switch to showing an example of the cash flows. And then, actually from the presentation. Yep.
I wish RG, but
This is really small. Can anyone in the back read this? We can make this bigger. All right, so hopefully you guys can read this. So this is just a very basic example of a cash flow. So I did this using the cash method. So there's multiple different ways to set up your cash flow. I use what we call in the accounting world as the direct method, where you're just tracking the cash flow, the ins and the outs of your cash. So you can see here at the top, I just took, your wholesale, your tap room sales. So you can see those are positive numbers. That's cash coming in. So you're going to use that as your cash inflow. And we have our cash outflow here. We have inventory, we have brewers, tap room employees, rent, utilities, all that. So all that comes down and that's going to become your cash flow from operations. So you can see the first week of the month, we have a lot of things coming out of there. You have your rent, you have your utility bills, things like that. And we have negative cash flow for that first week. That doesn't mean you should panic and just get really scared that you have a negative cash flow for 1 week. Because remember, some of these expenses are a one-time, once-a-month expense. So as Chris was saying, you can't just only look at this from week to week. You also have to look at this from month to month to know when you're going to have to pay those things, so you can have that cash on hand to make sure that you're able to cover for the outflow of cash instead of a net inflow of cash. If you scroll down. So then we have our investing activities. That would be equipment, purchases of equipment here, your financing, that's the repayments of your debt. And then at the end here, you can see that the first week we have a net decrease in cash for the week of $8,130. So, and then we start with our bank account balance at the beginning of the week, and then you have your cash in the bank at the end of the week. And your check basically is, did my cash in the bank change by the same amount of my cash there? And if it doesn't, then also think about those outstanding checks that you have. So factor those in there, and hopefully you should come out with a $0 difference, and you're kind of tracking this now. You'll see I have 4 columns here. There's 4 weeks, so this is just like 1 month's worth of expenses and cash flows. But as you build on this tool, you're going to have more data. You're going to be able to see how those trends are. For example, in Rochester, it's parade day tomorrow, Saturday. So Chris can look at last year's cash flows and see what were my sales, what were my cash intakes from parade day. Hey, I want that number to go up. So he can plan ahead to make sure, one, he's got the inventory, he's got the production for the parade day, and he can figure out ways, if I do this with my marketing expenses, if I advertise a little bit more, if I do this, hopefully I can bring in more people into the brewery for those sales. I can get my beers out to more bars. I can make those phone calls and make sure that I am going in the right strategy here. So there, again, many different ways. The more lines you can add here, the more ways you can track your expenses, the more informed decisions you can make. You can track to make sure, hey, this expense is ballooning. Why is that ballooning? You can investigate that. Sometimes your employees are making purchases and you think that they're necessary, then when you take a look at it at this level, you're going to realize, hey, was that really necessary? At that time, it seemed like, hey, that was a really good idea. Now looking back, not such a great idea. Let's cut that expense out, and you can start and look to maintain and figure out how you're going to get into that positive cash flow over the period of time. That is my presentation. Does anybody have any other questions?
Do a lot of people actually have 3 months of,
Well, it's very hard to do if you can get to a point to do that. And other shameless plug here, it's tax season right now. There's tax credits that are available. There's the employee retention credit available. There's all these things that are available that are going to help you also get back some of that cash. And hopefully when you have some of those big intakes of cash, you can keep those separate. Chris used some of his EIDL loan and put it into bonds and some stable value funds, things like that. And it's kind of out of his pocket, so he's not using it, and it's just building hopefully there. You don't want to go too aggressive because with the market these days, so keep it in more of a stable fund. Talk to an investor about that if you do something like that. So there's ways to kind of pull some of that money and put it in an account that you really don't have too much access to, and learning to live again with the brewery a little bit below your means if you can, and then building up that reserve. So it will take a while, especially if you're in your infancy. It feels like always cash is just going out the door. So as you're starting out, really building these cash flows is really going to be important to making sure that you are able to stick around for next year and the year after that.
And like Kurt said, it is tax season. The employee tax retention credits are huge. The SBA did a ton the last couple of years to help a lot of local municipalities, had grants. Make sure you're looking into these. You won't apply for all of them. You won't be able to get all of them, but like, cities are always looking for help with investment and businesses. So make sure if there's money on the table, check them out because they can really help you build up some of that cash reserve that you may not have.
And shameless plug again, my colleague Kate Van Bramer, she's going to be doing a presentation tomorrow on some of those tax credits that are available. So I encourage you all to go to that.
Maybe it's a question for tomorrow, but has anyone actually received their credits yet?
A lot of people I've heard have not. It takes like 6 months to get it, but in 6 months a check might show up from the government. It's at least worth putting the application in, trying. So.
Chris had just mentioned grant money. We've got a lot of what are known as completion grants out there that we don't get that money until we hit a certain performance marker.
Right.
Do you count that as somehow, money that's in the bank, just not today, or do you just pretend like that doesn't exist until it physically shows up?
I typically go with, if you don't have it, don't count it. That's going to keep you from making decisions that could end up putting you in the wrong position, because what if you aren't able to, or that grant suddenly comes back and says, oh, we reduced that. We have seen with the government, some of those funds that they thought were going to be allocated to you, the budget didn't clear and it got reduced. So try not to just expect that exact dollar amount. Try and project where it's going to come in. That is good, but I typically would not make too many informed decisions based solely on that influx.
And another shameless plug out there. I work with MNB. I also, my wife works for another accounting firm, so I have a lot of accountants in my life, and they are an amazing tool. MNB is an amazing company to work with, but they can help you if you don't know how to set up a cash flow tracking spreadsheet, or you're overwhelmed by the thought of, well, what do I put in there? What are the things I need? Talking through with an accountant can help you really find what's important that you need on there, because too much information is too much information, and doesn't help you. But I highly recommend working with these guys. They've really specialized in the craft beer world, and I shameless plug.
Appreciate that. We like to have fun, and beer's a great way to have fun. Yes, sir.
Thinking about investing in new equipment, return on investment, obviously, as soon as possible, but do you guys have like a goal that you typically do, like 1-3 years, is there a certain time when you would decide to not buy something? It's gonna be like a 5-year return on your investment type of thing?
I think you really, for that one, you kind of have to look at where your books are, your income is right now, and where it's going. Can you afford that? Can you afford to wait that long to see that return?
It's a long time.
Yeah. So that's where, again, that forecasting is really going to be important. And by having that historical data, you can also look to the future using that. So, again, not everything you buy is going to have initial ROI, but there's some purchases that you're going to have to make, and some that you will see. And if you can track some of those things and you can see, okay, where am I at? How has my business changed since making that purchase? You can also kind of make those other informed decisions to say, oh, okay, I could see the direct benefits of this purchase. Maybe I need to make a second one because that's going to take me to that very next level, and I've already seen that be a success.
The only thing I would say in addition to that, I think you have to look at all of your equipment kind of in conjunction with each other. So if buying an extra bright tank will, cut X, Y, and Z in half, I can leave a logger in it for longer than, they take forever to make. I can make more, yay, I can do this, I can do that. So don't look at that one piece of equipment as, what's this gonna do for me? Like, what is this gonna allow me to do with everything else? Like, what's that gonna free up? So I would think of it all together.
Anybody else? All right, thanks everyone. Have a great rest of the time.